Alright everybody, welcome back. Today we are going to be discussing call options. This is going to be one of the first videos in this series about options and then call options in general. So today we're just going to go over specifically what a call option is in the very basic sense. Up on the screen here you'll see, you can see basically it's called an options chain, so you can see every contract that's available for trade on this specific stock. So the stock we're going to use as an example today to explain what a call option is SNDL. I mean, for those of you watching the market, you probably have come across the stock. This is one of the stocks I've been trading a lot of options on recently, specifically call options, for their very lucrative premiums for such a low priced stock. But not to get too in depth to that right now. So we're just going to go over specifically what a call option is and how you can use them to generate more income for you, whether it's on a weekly basis, monthly basis, or whatever time frame you seek. So to get right into it, call option is a contract that gives you as the buyer of the contract the right to buy the stock at a certain price by a certain date. So here we're looking at the SND options here for March 5th that expire. So options typically expire every Friday. Some stocks have weekly options, some of them just have monthly options. Either way, you will see all the possible time frames right here, all the way from March 5th, this Friday, all the way until January 2023. Then here you have the strike price. So 50 cents a dollar, $1.50, and so on. And then obviously there's a lot going on the screen, so we're just going to try to keep it as simple as possible. So we're just going to ignore the put side, which is the right side for now. So here we have just the calls. So if you wanted to buy the stock for $1.50, you have the contracts right here that are trading between 10 and 15 cents right now. The market's open right now, so all this data you're seeing right now is live. Now, the reason you would want to buy a call option for $1.50 instead of just buying the stock, which is currently trading $1.38, $1.39, is because if it goes down below this, you have potential to lose $1.38 per share. On the if it goes down, but you bought the contract at 10 or 15 cents, that's the most you can lose is 15 cents per share. So you're not using as much capital or collateral to get into the possibility of making money off this stock and a move in this stock. So and options contracts are also traded in 100 share increments. So this 10 cents is actually $10 right here. So every contract is worth 100 shares of a stock. So here we're gonna now we're gonna jump right into how you can generate weekly money from selling call options on a stock. So I currently own 200 shares of SNDL. I already have one contract, a call option sold on it, so I'm only going to be able to show you one trade today on this stock specifically. But I usually try to sell them every week. So you can see that there's nobody bidding at them above $2. All the bids are at 0. So I mean, you could still get filled at the ask if you sit at the ask price, but I mean, I want the guaranteed money. So I mean, and I bought the stock at less than $1.50. So I am going to sell one call option right here at 10 cents. So we're going to put it in as 1, and I'm perfectly fine with taking it at 10 cents. I mean, I could put it at 15 cents and try to sit there, but I mean, you can see that there's currently over 11,000 contracts trying to, now with 13,000 contracts trying at 15. I mean, it could still get filled at 15 by sitting there, but I want the money, so I'm just going to take the 10 cents and be happy with that. So you can see there's only 98 sitting at the bid, so we kind of want to move fast if we want to hit that bid. And again, if this goes above $1.50, I'm perfectly okay with selling the stock at $1.50 because I bought it less than $1.50. So I would be making money on that stock price increase as well as the 10 cents per share by selling this options contract. So here it goes. So, sell one contract for the expiration of this Friday at the $1.50 price limit, 10 cents on the bid. So preview 948 after, the credit and fees, which is perfectly fine, in 1 week, and send. And we can see we actually got filled at 11 cents, so we actually got $1 more than we were expecting, which is obviously good. More the better. Now, in later videos, I will go over, if you do want to keep the stock and the price of the stock goes above $1.50, there are things you can do that don't cost money. They can still generate a credit, and it's something called rolling options. That'll be in a more advanced video, but it would allow you to still make the money and still keep the stock by rolling out your options to a later time frame. Because if you do look at, just to quickly go over a little bit more about call options, is when you see the bids at 10 cents, 15 cents, ones that expire this Friday for the $1.50. Now you compare it to the ones that expire next Friday, 11 days from now. You can see there's bids at 15 cents to 20 cents. So just by going an additional week out, you're already getting higher prices. And you can see there's now bids at the $2 and 250 cents as well. So, when it comes to options, one of the big things, and then eventually we'll go over the Greeks and what they are. You got the delta, gamma, theta, vega, and rho. When it comes to time, that's measured in the theta. And we'll, go over in the future what all this stuff here means, because don't want to get too complicated right here at the beginning. But basically the value of options is two things. There's intrinsic value, which is how much the stock is what's called in the money, and then there's something called time value of the money, time value of the contract. And so, by this extending the expiration date of the contracts, they are now worth more money because there's more time for the stock to make a move. And you can see here now. Now look at the bid on the same contract they just sold. It's now at 5 cents, and the ask is at 10 cents. So it was a good thing that we moved pretty quickly and took that bid, because I was okay with that. Options, on the week of expiration do decay in price pretty quickly. So if you like the price, just take it. Don't sit there and try to, I don't sit there and try to just get every single penny out of it I can. I'm just, glad to get a little bit of something. So that's one of the big things when it comes to investing, trading, anything in general. Just don't get too greedy. Just get what you're happy getting and get out. Alright, so I think that's going to be it for this video on just the basics of what a call option is and watching a call option trade. We'll go more into options, and then we'll switch to the put side of options in the future as well. So thanks for watching. Feel free to subscribe and like the video, and I'll see you guys next time.